Welcome back to the Wizards of Dalal Street. I'm chatting in Chennai from the CIO of Franklin Templeton, ANAND RADHAKRISHNan. ANAND, we went into the break saying growth, that's what you like. The fund that you now are CIO of, Franklin Templeton. Templeton was a different kind of investor, wasn't he?
Yeah.
Tell us about him.
So John Templeton is a very well-known value picker, and he's more behavioral-based value picker. As in, his basic tenet is to buy stocks when others are afraid to buy and
when
sell.
there's blood on the street, I was told.
Yes. So he strongly believes in the tenet that bull markets are founded on
depths of despair.
Depth of despair, pessimism. They grow on skepticism. They mature on optimism, and they die on euphoria. This is his words.
Exactly.
And
profound words.
And he strongly believes in those playing on the behavioral aspects of the market. And that's one way of making money, which is to buy when others are throwing out their stocks and to sell when others are greedy for their money. But when Templeton took over the Qatari Pioneer, they took the team which was essentially growth-oriented stock pickers. They were buying ideas which were growing very well.
That's the DNA.
And Franklin Templeton has this philosophy of when they make an acquisition, they continue to allow the teams to follow their approach. They don't try to fit you into their existing culture. While they while the firm takes a lot of steps to sensitize investment managers on the bigger philosophy, they are also allowed to follow their own style.
The 2013 bull market, what is it rewarding this time around?
I think the market has significantly rewarded the quality companies. I mean, quality has been the most sought after aspect of the current market rally, and quality in terms of business, quality in terms of financial parameters, low leverage, high cash flows and repeatable cash flows, low volatility of earnings.
But to a ridiculous level? I mean,
I think like it always happens at every cycle. In 2003, the world economy, the traditional industries were excessively undervalued. By the peak of the market, the consumer staples and pharma companies were excessively undervalued. I think by 2014-15, maybe
the reverse has happened. The pendulum has swung.
In some way, the pendulum has swung the other way.
We run thousands of crores. How do you fish in these seas?
These are very challenging times, especially when we know that the market pendulum has swung one way, and then to make choices and position your portfolio, not necessarily for the next 6 months or 1 year, but looking through that into next 2-3 years is a very tough proposition.
So give me a checklist of what you do. How do you find companies now?
Currently we are looking at more than current growth. I would say we are looking at the growth potential of that company. For example, a company who may not be growing pretty well, but doesn't require too much of capital to grow their business, because they already might be sitting on excess capacity, underutilized capacities, reasonably not excessively leveraged balance sheet, but we don't mind a bit of a leverage because we think that both operational leverage and the financial leverage essentially can, if things grow better into the future, you will get good growth. We don't want excessive leverage in that. So yes, you are looking for therefore companies which are slightly underutilized in their current capacity. Balance sheet may not be pristine clean, because pristine clean balance sheets are anyway overrated, or that pendulum swing has taken their valuations to a very high level. So it should be reasonably clean.
I could be wrong, but it almost seems like it's suggesting commodity stocks.
Commodities might be like really a deep value. I think they are going to be stressed for some quarters at least, if not for some years, going by the way things are now. But
so which sectors? Tell me which sectors you find.
I think one is automobiles, both four-wheelers and two-wheelers. Some of the auto ancillaries definitely qualify for taking a very pro-cyclical kind of a bet into next 3-4 years. That is definite value. They are not overvalued by compared to the broader market. Similarly, we are seeing opportunities in cement. We are seeing opportunities in banks. Even if you are a cyclical investor, even one may find value in some of the PSU banks also. Though while I would still put a lot of my money in a high growth private sector banks. And we also can find value in some of the good utility names at this point of time.
Are you scared that if a global meltdown takes place, that a repeat of 2008 will happen?
The world is a little bit awash with liquidity. So clearly there is a risk to the global equity markets. When it comes to India, I think the risks are much less today than what it was in 2008. 2007 we were at cyclically peak earnings. Commodities were at all-time high. Economic growth was at all-time high. Sensex was roaring. Valuations were at all-time high. Today, if you look at it, commodities were at all-time low. I think because of a high inflation, our interest rates are at a very high level. So we are nowhere near the kind of the real interest rates that were prevailing in 2007. So in whichever way I cut and dice, I think the risks are a lot less today from a global contagion to affect us, because what we saw then was a very synchronized expansion across the globe and therefore a synchronized fall.
I just have to take a break.
Yeah.
We'll take a commercial break, come back and chat some more with ANAND RADHAKRISHNAN, CIO, Franklin Templeton.